The Bank of England required a £65 billion recapitalisation when gilt prices fell sharply. The ECB faces potential negative equity that could require tens of billions in recapitalisation if losses are realised. These losses don't vanish. They eventually move onto public balance sheets, connecting monetary intervention directly to fiscal outcomes. The Bank of Japan earns minimal or negative returns on many of its government bond holdings, a byproduct of persistent low-rate policy. Regulation and policy reinforce this structure. Italy, for example, requires its banks to hold government bonds equal to 10% of deposits, well above the EU average. Japanese banks and insurers hold vast sums of government debt, often because regulations and prudential standards push them to do so. This captive demand keeps borrowing costs low, but distorts credit markets and crowds out private investment. Retail investors are drawn in as well. Japan's NISA program channels household savings into government bonds through tax incentives. The UK's National Savings and Investments bonds offer below-inflation yields to help fund public borrowing. These aren't just savings products. They're tools for financing government deficits by tapping household wealth. The result is a system where monetary and fiscal policy are deeply intertwined. Central banks act as key funders for government spending, and their decisions now shape fiscal sustainability as much as inflation or employment.